Hey guys, today we're going to talk about what is a transition to retirement strategy. Now, as discussed before, there are three types of superannuation accounts. The first is an accumulation account. The second is a transition to retirement income stream, sometimes also referred to as a TRIS. And the third is a full account-based pension. A transition to retirement strategy allows you to accomplish one of two goals. The first is transitioning over to retirement whilst maintaining your cash flow through taking a supplementary income from a pension while at the same time cutting back your hours. The second thing is boosting your superannuation capital through living off of pension income and thereby freeing up earned income in order to be contributed to your superannuation balance. Now, to first understand how this works, let's explore the rules around pensions in Australia. So, in order to be able to access a pension, you need to meet your preservation age. Now, currently, the preservation age in Australia is 60 years. That means anybody over the age of 60 is actually able to access a pension. Now, there are two types of pension that you can access. The first is a transition to retirement income stream. The second is an account-based pension. If you're over the age of 60 and are no longer working, then you have access to an account-based pension. If you're over the age of 60 but under the age of 65 and still working, this is where a TRIS pension comes in. Now, both of these pensions are quite similar, but they do have a couple of differences. The first is, within a TRIS pension, you still have the same 15% income tax and 10% capital gains tax that you have in an accumulation account. Inside of a full account-based pension, the tax internally is zero. The other difference is with the TRIS, you're only able to withdraw 10% per annum outside of the fund, whilst with an account-based pension, you can withdraw the entire balance, even though it might not be a good idea. You could withdraw the entire balance all at once if you wanted to. Now, both of these pensions actually allow you to take income from them tax-free over the age of 60. So whether it's a TRIS or an account-based pension, any income that you withdraw from either of these two accounts is tax-free. Now, a transition to retirement strategy relies upon the tax-free status of this income in order to facilitate your capacity to make further contributions into your superannuation. Let's look at a case study. Imagine we had a 60-year-old who's earning $100,000 per annum, and their employer is already putting $11,500 per annum into their superannuation as part of their superannuation guarantee contributions. This means that they have $18,500 remaining of their $30,000 per annum concessional contribution cap. If their income is $100,000, that means that the tax they'll pay on that income in the 2024-25 financial year would have been $22,788. In this instance, we can imagine that the individual in question doesn't have any spare cash flow in order to boost their superannuation. Now, if we were to appropriately structure their pension and transfer $200,000 over to a TRIS pension, for example, they would now have access to $20,000 per annum tax-free. With this income, they can cover their ongoing expenses, leaving more of their earned free cash flow available for contributions into their accumulation superannuation account. If they contributed up to the cap, that means they'd be able to contribute $18,500 per annum as concessional contributions, bringing their taxable income down to $81,500 from the $100,000, and therefore their tax payable would be $16,868. That's an income tax saving of $5,920. Note that when you contribute money into superannuation as a concessional contribution, there's going to be concessional contributions tax. That's currently 15%, which means on an $18,500 contribution, tax of $2,775 would be payable, resulting in a net tax saved of $3,145. Now, if this individual continued working to age 67 and the funds were invested and accumulated an 8% per annum return, this would result in an extra $27,254.45 at retirement with no extra impact on their cash flow. This strategy can be further enhanced through actually combining a TTR with a carry forward contributions cap strategy. So an individual might actually have way more accumulated in their carry forward caps that they can actually use utilizing a TTR strategy to really effectively supercharge their superannuation balance, utilizing those previously unutilized caps. As such, it's a strategy that many people would benefit from implementing, but most Australians don't implement for themselves because they don't understand it or they don't know about it. So if you're interested in exploring this strategy, it's one of the more intricate ones, so please reach out. We're currently offering free consultations for anyone that's 60 and above or has a family member or a friend 60 and above. So please reach out for a free consultation so we can help you out and point you in the right direction. As always, if you have any questions or comments, leave them in the comment section below and we'll get to them as quickly as we can.